I'm joined today by Keith Breslauer, Managing Director and founder of Patron Capital. Thanks for joining us, Keith. You recently raised 860 million euros for Fund 7. What's the strategy of the fund? And I guess, why do you think this was of specific interest to investors at this time?
The strategy for the fund is we define as value add and opportunistic. Many people have different versions of what that actually means, but in our world, it means we're investing in a property which tends to need a bit of love, a bit of attention. It might be vacant, it might be need major refurbishment. There's something that has to be adjusted or done to the asset. It may even be bringing it up to energy standards of an EPC A or B, which is our primary goal. So our strategy is to focus on those opportunities. And why it's particularly interesting now is that you have a combination of borrowers who bought assets over the past 5 or 7 years who have been through a significant interest rate shock, combined with environmental regulations that have been imposed or being imposed that will require quite a lot of capital. So if you're a borrower or you're an owner of an asset and you have quite a lot of leverage and you have an issue with ESG, then likely you may have a problem. So we think that's a particular opportunity right now because both things have happened. So even though rates have now flat and expected to come down, the combination of, however, debt issues along with ESG issues has created an interesting opportunity.
And the fund has a focus on Western Europe. Are there specific countries or geographies that you favor?
Well, if you think about what drives us, which is that first example of interest rate shock, it would be where people have more leverage than normal. And the place where you see a lot of leverage tends to be in the more mature markets, which is the UK and Germany. So I would assume that at least half of our investment strategy would be in the UK and Germany, and about, let's say, 25 to 30% would be more in Spain and Portugal, and then the balance would be through the rest. That would include Benelux, France, Italy, etc. So the UK and Germany tend to create the opportunity on the credit side. However, across Europe, you have the ESG challenge.
And looking at the sectors, Keith, are you sector agnostic? Where do you see the opportunities?
I would say we're generally sector agnostic in the sense that we're always looking for opportunity. The third leg of the opportunity set would be the supply and demand. So that's where you have limited supply or no supply, and you have very decent demand. Where is that prevalent? Residential, for sure. So it is clear that residential would be a place that we would go. The challenge is there an opportunity driven by the credit dynamic? Maybe, maybe not. By ESG, not obvious. So, when we think about the world, that's how we kind of space out the opportunity, which is the supply and demand dynamic. We like the mid-market in terms of buyers. So we're going to do residential. We've never done high-end residential. We've only done one 5-star hotel. Everything we do tends to really be focused on that larger middle market.
And you mentioned making assets ESG ready, Keith. Typically, what proportion of the investment would be for the capital value, in terms of buying the asset in the first place, and what to the transformation in terms of ESG, or is it not so easy to tell?
It's generally not easy to tell, but let's unpack the question. Buying it cheap always is helpful. So I would say, as a general point, the entry price of an investment is the most important starting point, because if you get it cheap enough, or if it's of good value, then you could continue to earn very good money from it. So that really is a priority, which is valuation today relative to the journey. On the ESG dynamic, it's tricky. It's somewhere between 5 and 25% of total cost is estimated to be an ESG refit. The range is significant because you're not sure what kind of quality building it is. Are you going to an EPC A or a B or potentially a C? What are the dynamics with respect to the age of the building, et cetera? There is a view that hotels, for example, have a requirement of 15 to 20% to convert. So 15 to 20% of the cost of a property is what it will cost. In our experience, it's more in the lower end of the range, but it really depends on what you end up doing. Part of the challenge is, since we're usually refurbishing an entire building anyway, the extra environmental aspect is a relatively small percentage because we still got to spend the money on the refurb. It's more of a matter of making sure that we're building it to the right standard.
And you've already committed capital from Fund 7, Keith. Is there an example in terms of some of these investments, potentially both property or property-backed corporate investments?
In the current fund, we haven't done any property-backed corporate deals per se. What we have done, for example, it's public, is we bought the Livingston factory outlet in Scotland. And the premise there was that the building needed significant refurbishment in the roof. It's going to take some time to do that. It's very good leasing. The management did a very good job managing the asset, but the capital structure was not robust. And therefore, we saw an opportunity to acquire the investment, to refurbish the roof and a variety of other bits, continue to drive up the high quality standard, and then look to exit in, say, 4 to 5 years. That's an example. That building is 90% leased. So it's very operational, it's doing very well, but ultimately it has an asset issue, and the issue is in what's going to happen on the roof. So that's a classic opportunistic type investment that we would do.
And obviously, this cycle maybe has more opportunities than other parts of the cycle, Keith. So I guess, how long do you see this part of the cycle lasting? And I guess, how have you seen the opportunities change over the period of the seven funds?
So in terms of the first question, a lot of it's really driven by rates. If interest rates were to fall, say by 100 basis points in the next 3 months, much of the opportunity that we have been shown or looking at would probably not get sold. So, and if I compare the size of the opportunity set today versus the past, we're probably in the third best opportunity set. The first was in 1992 when I first came to England, and there was a declining. We had rates that were very high, north of 12%, and were coming down. There was a lot of challenges and not a lot of competition. The second was 2009, which was obviously post the global financial crisis, and therefore lots of credit that's distressed. And now there's a third, which is not necessarily purely by credit, but the whole dynamic of a weak economy for capital structures, and also a requirement to refurbish assets to bring them to make sure that they're not obsolete. So the big difference this time is that you have an acceleration of obsolescence. Normally it'd be X number of years before the building wouldn't be viable, and you have to spend a lot of money on fixing it. Now it's in the immediate because the environmental requirement. Over seven funds, it waxes and wanes. If you think about the distressed part of the world, you had the post 98 LTCM crisis that was distressed. You had the one or two mini crises in between, and of course you had the 2008 global financial crisis. Then we had COVID, and then we had the interest rate shock. So what COVID has done is that it essentially reduced the amount of new supply that got built in Europe, although there's still a lot of shadow supply. And when when we came out of COVID, the economic recovery was good, and we're still going through that. Europe, unlike America, still has, or is perceived to still have, a significant excess savings. So as it keeps getting released into the economy, you'll see a continued boom in from a consumer perspective.
Real estate investment is plainly a major focus for you in the business. But I'd also be keen to learn a little bit more, Keith, in terms of some of the activities beyond real estate, because I think there's a strong focus in terms of charitable initiatives, for example.
We decided many years ago to give 10 and 20% of what I make away. So I don't take it out of investors or anything like that. It's what I make. And I give 10 hours a week to charity. And I expect the team to do something similar, something where they're giving back. And our whole organization is very much involved in that. There are three big ideas: veterans, education, and infrastructure. Infrastructure is a Women in Safe Homes Fund, which thank God has done very well, which provides permanent housing for women suffering domestic abuse. Then you have education, where I chair the largest charity for professional development for state school teachers. And then the veteran aspect is we're very involved with the Royal Marines, and I'm a vice patron, and we've been involved for 14, 15 years. We have the D-Day anniversary coming up. There is supposedly 25 people or veterans who are still alive who fought in D-Day in the UK. But we are honoring them I'm going with 19 Royal Marines serving and veterans, and we're going to paddle in kayaks across the ocean from Portsmouth down back to France. We're going to follow the D-Day route. We'll have a few landing crafts with us, and we're going to do it on the anniversary. So hopefully that works. We've raised a bit of money for the Royal Marines charity, which is very good. And I'm being joined by Lee Waters and Joe Maynard, who are really the organizers of the whole thing. So I'm very pleased to be invited to it. I did something similar to it 10 years ago when we went from France to the UK. So I'm hopeful that we could recreate it, although I am 10 years older.
I look forward to catching up both on the performance of the new fund, but also your performance in crossing the channel. Thanks very much for joining us, Keith.